Good afternoon, this is Sean Golden with Golding & Golding, here to discuss the basics of the United States-Japan tax treaty. Specifically, we focus on individuals and how things such as pension and passive income is impacted by the treaty. Now, the United States and Japan first entered into a treaty a while ago, over 50 years, and there's been a revised version, protocols, things of that nature, which brings me to my first point. When you're going through a tax treaty, it's important that you're looking at the most recent version of it. When there's protocols in place, those protocols will not necessarily update every article. So you've got the tax treaty. Tax treaty is made up of articles. Sometimes there'll be an entire overhaul of a tax treaty. Sometimes there'll just be protocols that update certain articles and provisions. So something to keep in mind. Make sure you're looking at the right thing. It gets super complicated and confusing. The IRS doesn't always provide the necessary updates that you need. Tax treaties typically involve citizens and residents between the two contracting states or the two countries to the agreement. And certain income may be taxed differently based on how the treaty applies. And of course, one thing you always have to keep in mind is the saving clause. So you'll have the tax treaty that'll say this, and then you have the saving clause that says, we don't care what it says, the United States or Japan, we're reserving the right to still tax you the way that we want, as if no treaty was in place. And then there are certain exceptions or exemptions to the saving clause that say, hey, despite the US and Japan holding on to the fact that they can still tax under general principles of law that they would otherwise tax on, these specific items that are carved out from the saving clause are still going to be based on whatever is in the treaty. So why don't we jump into passive income, which is typically where it impacts a lot of different people that we deal with, at least in our practice. So typically when you have passive income, some of the key components are dividends, interest, and real property, rental income, things of that nature. Dividends are generally taxable by both countries. But what will happen is if someone's a resident of one state and they're receiving dividends that are sourced in the other country, they use contracting states on the brain right now, but either country, okay? And so you're a resident of one country, the dividends are sourced in the other country, the resident country can tax you, and then the source country can tax you as well, but up to a certain percentage based on the ownership interest of the person in the company generating the dividends, and it's limited to 5 or 10%. Interest is a little different. It's primarily based on residence, but as you can imagine, there's many exceptions and exclusions and limitations to that paragraph, so you want to make sure you go through the subsequent paragraphs in the article to make sure that you don't fall into one of those exclusions. Real property may be taxed by either country, which is typical. But not always true. Like some treaties will use a different verbiage. They'll say something like shall only be taxable in country A or B, as opposed to may be taxed in either country. So that's something to keep in mind. Another key component of any tax treaty is pension, right? You worked hard, you're retired. Who's going to take your money? Who's going to tax it? How do you deal with it? So generally, Social Security is only going to be taxed at source. Okay, so normally, like the United States can only tax Social Security that's issued by the United States. But there's exceptions, especially for U.S. citizens and residents, depending on if they reside in the other country. So that's something to keep in mind. Private pension is typically taxed in the country of residence. Now, it's exempt from the saving clause, which, initially you're like, yay, that's great. Because maybe I'm living in Japan, I'm earning pension from the United States. Japan doesn't tax this pension, so I wouldn't be taxed. But of course, the U.S. is onto you, and so they have some exceptions or limitations to U.S. citizens and residents. And government remuneration is a little different. And this is typical in most treaties. If you're earning, public funds, you're earning money from the government, then only that government, the source, can tax you. But if you're living in the other country, for example, or other exceptions, then the other country can tax you instead or as well. So that's something to keep in mind. If you're out of compliance, if you haven't properly reported your income, assets, investments, FATCA, all those ridiculously annoying acronyms, that's what we specialize in here. There's various programs that you can use. They're safe. There's the Voluntary Disclosure program used for offshore or domestic, and it's for people who are either willful, not necessarily criminals, so avoid all the ridiculous, stupid fear-mongering you'll find online. you just can't you're not comfortable certifying under penalty of perjury that you're non-willful. There's there's not alternatives to VDP if you're willful. Alternatives would be the non-willful options, which is the streamlined domestic offshore procedures, streamlined foreign offshore procedures, and then the alternatives to those would be delinquency of reasonable cause based on the individual's facts and circumstances, and they differ. So it's important to go through each option at the time you're deciding which program to choose. We have lots of free information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.